All right, let's dive right into this explainer. Today, we are putting on our professional equity analyst hats to conduct a really rigorous, completely numbers-driven stock valuation. We're looking at a biotech company called Alkermes, ticker symbol ALKS. And look, our goal today isn't just to glance at a stock chart and guess. We are going to dig deep into the raw financial data, the annual filings, the actual cash flows, the balance sheet, and figure out the true intrinsic value of this business. We're building out professional valuation models to see what Alkermes is actually worth underneath it all. To start, we have to anchor ourselves to the current market reality, which is $33.38. That's the last closing price of Alkermes. I want you to treat this number as the core mystery that we need to solve today. Is $33 an absolute bargain? Is it wildly overpriced? Or has Wall Street priced this thing perfectly? You see, as an equity analyst, you never trust the ticker price blindly. You stress test it. And that is exactly what we're going to do right now using 3 distinct valuation pillars. So here is our roadmap for the analysis. First, we'll establish the valuation baseline. Then we'll run the absolute valuation models, followed by relative valuation benchmarks and an asset-based NAV approach. Finally, we'll wrap it all up with our synthesis and final value.
Okay, step 1, the valuation baseline.
Before we can even think about modeling the future, we have to understand the exact financial footprint of the company today. So we've pulled the core baseline metrics straight from their latest filings. We're looking at a market cap of roughly $5.5 billion, which is driven by $1.47 billion in trailing 12-month revenue. But honestly, the number I really want you to focus on is that bottom one, $480.29 million in free cash flow over the last 12 months. Free cash flow is literally the lifeblood of intrinsic valuation. It's the hard cash left over after the company pays for everything it needs to keep running. A near $500 million cash engine, that is a massive starting point for our models. Moving on to step 2, absolute valuation models. Now, absolute valuation doesn't care what the rest of the stock market is doing or what's trending on social media. It only cares about the cash this specific business generates. And the undisputed gold standard here is the discounted cash flow, or DCF model. Simply put, we project all the future free cash flows the company will make, and we discount them back to what they'd be worth today using a weighted average cost of capital. Let's break down how we actually do this with the Alkermes data. Step 1, we start with our baseline, that $480.29 million in trailing free cash flow. We know from the data that Alkermes has a trailing cash flow growth rate of 18.3%. If we project that highly impressive growth forward into the near term and then apply a standard conservative terminal growth rate for the long haul, we generate a massive future cash pool. Step 2, we apply our discount rate to account for risk. And step 3, we calculate the present value to find our per share intrinsic value. And the resulting calculation gives us an absolute DCF intrinsic value of $241.18 per share.
Yep, you heard that right.
Now, think back to our $33.38 starting price. This DCF output implies a staggering 86.16% margin of safety. According to pure cash flow projections, the current stock price isn't just cheap. It's practically a rounding error compared to the cash this business is actually generating. But wait, as thorough analysts, we don't just rely on a single model. We also want to look at the dividend discount model, or DDM, and the residual income model. However, when we pull the data, Alkermes pays exactly 0 dividends. The dividend growth rate is 0%. So the DDM framework just completely breaks down. You can't discount dividends if they don't exist. We have to throw it out. Instead, we shift to the residual income framework, which starts with the current book value and adds future net income. Given Alkermes' solid 13.28% return on equity, this model strongly backs up the narrative that the company is generating really high-quality internal returns, perfectly reinforcing the strength we just saw in the DCF. Next up, step 3, relative valuation benchmarks. So, we've looked at the company in a vacuum, but now we need to see how the market is pricing it relative to standard valuation multiples. We've got a price-to-earnings, or PE ratio, of 23.34. An enterprise value to EBITDA of 17.52, a price to sales of 3.74, but the absolute most critical multiple here, it's the price to free cash flow ratio at just 11.79. In the biotech and pharmaceutical space, acquiring a company's free cash flow for less than 12 times the price is incredibly cheap. It signals deep potential undervaluation compared to typical industry peers, who often trade at 20 or even 30 times their cash flow. Now, what is really fascinating here is the trend in earnings multiples. While that cash flow looks ridiculously cheap,
The current PE of 23.34 is actually running much hotter than its trailing 12-month average of 17.59 and its 3-year average of 15.50. So what's going on? Well, this tells us a crucial story. Net income has temporarily compressed, which drives the PE up, but the actual physical cash generation of the business hasn't missed a beat. Wall Street might be getting spooked by a superficial earnings drop on paper, while totally ignoring the underlying cash machine.
Let's move to step 4, the asset-based NAV approach. This brings us to our final stress test. We are going to strip away all those future growth projections and just look at the hard physical assets and liabilities today to compute net asset value, or NAV, per share. The data here reveals something beautiful. The debt-to-equity ratio is exactly 0, a totally pristine balance sheet with 0 leverage risk. Next, we look at the price-to-book ratio, which sits at 3.04. The math here is pretty straightforward. If the current price of $33.38 is 3.04 times the book value, we just divide $33.38 by 3.04. That gives us an implied book value, or net asset value, of roughly $10.98 per share. So what does that actually mean? That $10.98 NAV is our absolute liquidation floor. If Alkermes stopped operating tomorrow and sold off every asset they had, that's roughly what's left for shareholders. The fact that the stock trades at $33.38 means investors are paying roughly a 3x premium over the physical assets. Why? Because they're paying for that powerful $480 million free cash flow engine we discussed earlier. The premium is entirely based on their future earning power.
Finally, step 5, synthesis and final value.
It's time to bring all the clues together for our final analysis. We have to weigh the strengths and weaknesses of each model we just built. Look at this landscape. At the very bottom, we have our rock-solid, zero-debt, asset-based floor of $10.98. In the middle, we have the current market reality, pricing the stock at $33.38. And way up at the top, we have the absolute DCF value of $241.18, which represents the immense power of their current cash flows projected out into the future. The discrepancy here is absolutely massive. So, as an equity analyst, here is the final verdict. Now, sure, the DCF model of $241 might be overly optimistic if that 18% growth rate cools down, which, let's be honest, is a known weakness of DCF models in biotech, where pipelines can be highly volatile. However, look at the foundational data. 0 debt, an 11.79 price-to-free cash flow multiple, nearly $500 million in reliable trailing free cash flow. This strongly signals that the current $33.38 market price is baking in extreme, unwarranted pessimism. Even with highly conservative growth estimates, this stock is severely undervaluing the company's cash-generating ability. The verdict? Definitively undervalued. But I'll leave you with this final thought to chew on. If our rigorous multi-model analysis is screaming undervaluation with an 86% margin of safety, we really have to ask ourselves, is the broad market just completely mispricing Alkermes, or does Wall Street see a cliff in those cash flows that our raw data isn't showing yet? That right there is the true art of valuation. Thank you for joining me in this explainer, and keep digging into the data.